Hey, what's up, Bob Mortgage Nation? This is the 12th episode of the Ask Bob Mortgage Show. You have questions, I have answers. Great question.
What I want to be able to do is give you world life experiences that I've been going through.
So the Ask Bob Mortgage Show is a way for you guys on social media to ask questions. You could ask about mortgages, team building, entrepreneurship, working with a spouse, which I do, sports and business, which we've played. You guys can ask these questions and then use the hashtag AskBobMortgage. And then every week my team's going to go through them, pick out the ones they want me to answer, and then we'll run this show this way where somebody's going to be sitting in and asking the question. So go out there, social media, hashtag AskBobMortgage. All right, 12th episode, we got Hector in this hot seat. So what's on? What's going on? What do we got?
We got video sent in from Madison.
Video.
Uh-huh.
Love my videos.
Nice.
All right, so you may take it and play it?
Oh, let's check it out.
All right.
Hey Bob, how do you think the recent election is going to affect the mortgage market?
Yeah, this one's a good one. So the recent election, now I'm not going to get political because I don't want to get in the political side of it. I'm just going to kind of address it as it relates to the mortgage market. Okay,
this blue is just a coincidence.
Right. Well, yeah, blue, red, it didn't really matter to me. I'll be honest with you. Here's what I'll tell you. The market is a whole heck of a lot smarter than any Republican or Democrat. Okay, that I will tell you. The market is smarter than a Republican or a Democrat. And so here's what happens, right? I think what we're going to see is a couple things. You know, the bond market, we're going to talk about interest rates as it relates to the question she had about the market. The stock market, as the stock market goes, so does the bond market. And if the stock markets are usually up, okay, bond markets are usually down. That means money is going into the stock market, which is pulling it away from the bond market. And as the bond market's down, interest rates are rising. So we have to really watch that stock market. Now we want the stock market to be going up. That means it's good for our investments, our 401ks, everything like that, right? It's good, but it could deteriorate the bond market a little bit, which would cause interest rates to rise. But there are other things that we have to look at. We have to consider tariffs. Right now we have a lot of tariffs that we're dealing with. And you know, the U.S. is pretty much saying here, look, it's not equitable for us based on the way these tariff rules are written, laws are written. We want to change it. And for instance, like China's going, well, we think it's pretty good, but if you're going to go ahead and change it, then we want to increase our own tariffs. And all that could impact imports, which is going to create more inflation. And as we know, inflation is really bad for the bond market, right? Inflation's bad. It erodes your fixed return that you're going to get on that bond investment. So that's also a negative thing. And then you got like the 10-year treasury, right? We have a 10-year yield that's sitting at about 3.1 something percent right now. We have a threshold that we haven't broken in a long time, which is 3.25. We break that, then it could run up to 3.5, 3.6, 3.7, and that's where all of a sudden the 10-year goes up, interest rates are going to go up. And we could start to see that pushing rates above 5.5%. And you know, I always look at also like what's happening around the world. I mean, we have things that are going on right now with the UK with Brexit. I mean, that has an impact. I mean, it has an impact. I mean, when the midterm elections were over, you had the Democrats got the House, the Republicans got the Senate, and the stock market was up and the bond market was up. So I don't know if it really has a direct relationship to what's going to happen, but I think those are the factors that you need to really be more concerned about as it relates to like the mortgage market and interest rates. So Madison,
Correct.
appreciate you so much for sending in the video. Great question. Hope that answers it for you. All right, what else we got?
Next question. Ezra on LinkedIn asked you, hi Bob, how's the real estate market looking out there? Any signs of a correction?
Okay. Areza? Mm-hmm. Okay. So I'm very bullish on the housing market. Been doing loans for 22 years, right? I have always believed in the housing market. I bought properties to buy and hold for rentals. I've bought fixed and flipped properties, and I've lived in my own homes. I'm very bullish on housing, and I still remain bullish on housing. I do not believe right now we're seeing a correction in the market space as it relates to our real estate market. Let's just talk about Texas for the most part, Dallas-Fort Worth, a lot of the San Antonio, Austin, Houston, the bigger city areas. I think what we're seeing is more of prices becoming more realistic with the expectations the seller is placing on their listing price. Because as you have less inventory and more buyers, right? Supply and demand, less inventory, more buyers. What we saw was that $200,000 house that the market told us it was really should be priced at as far as us as lenders and appraisals. Sellers were saying, let's price it at 210 or 215. And buyers are willing to pay that because there wasn't as many homes on the market. And there was a lot of buyers activity going for that one property. So you might have had 30 buyers trying to bid on that $200,000 house. And so they were able to come up with the extra $10,000, $15,000 to overpay. Okay. So what we've seen with, sometimes, like interest rates rising, we've started to see more inventory get on the market, especially now it's seasonal. We're in the slower months. We're starting to see more inventory come up. And the buyers are now paying that $200,000. And the sellers are starting to readjust their thought process. Listing agents are talking to them and saying, look, your house has been on the market for 30, 45, 60 days. We need to start pricing this correctly. Take it from 210 to 200. And that's exactly what we're seeing in this market. So we're not talking about depreciating, real estate. Depreciation is not there. It's just resetting of an expectation for the listing agents and the sellers on their price. Bullish on housing. I don't think we're right now in a correction at all. Okay?
Okay.
Thank you so much. Appreciate the question. Anything else?
Yes, one more question. Dan on LinkedIn asked, hey Bob, what's your opinion? When an agent or buyer asks for an approval letter or a loan estimate and the loan officer is out of pocket, do you think they should wait or should the LO drop what he's doing?
Okay. Well, Dan, I'll tell you, I guess it just depends on the relationship you have with the listing agent or the buyer's agent. It depends on the timing of that offer. It depends on what that loan officer is doing and how they set that pre-approval up in the very beginning. Look, we're here to serve, right, our clients, and our clients are our borrowers that are borrowing homes and the real estate community. That means the buyer's agent and the listing agent. So, what we do, and I know you know this, what we do is we'll pre-approve a buyer. Let's say we get them all done, they're pre-approved. We go with a maximum of pre-approval. So let's say it's a conventional, the maximum pre-approval they have is $400,000, right? But they're only looking at homes in the $300 to $350 range. Well, we're automatically going to give them a pre-approval for what they're looking for. So if they say, hey, we're really looking for about $325, okay, great. We'll give you the pre-approval at $325, and then we'll also generate another approval at the maximum amount of $400. That way that the buyer's agent and the buyer has all that information ready and available to them. Now, we do know that typically Friday, Saturday, Sunday, they're out looking for homes. Mm-hmm. And we do make ourselves available, right? So if that buyer's agent says, hey, we're going to make the offer, it's going to be $338, and we don't want to use the $400 as the offer or the pre-approval letter that we're going to do, would you redo it? Sure. We got all of us on the team, we have access to our systems anywhere we are. There's Wi-Fi in cars. It's pretty easy now where we just basically take 5 minutes, pull it up, issue the pre-approval letter, and get it to the buyer's agent. More importantly, what we do, Dan, is we also call a listing agent. I think that's a big thing, which separates us quite a bit, is we actually make a phone call to the listing agent and let them know that, yes, the buyer is pre-approved. Yes, they can perform based on the terms that are in that contract. And yes, I know our buyer's agent put a 9 or 12 or 13-day close. Yes, we'll be able to perform during that time period as well. So it goes into much more than should they be available. Yes, they should. They should drop things. That's our responsibility, I think, to our group and our clients and our people. But there's other ways to help mitigate that where you can make a phone call, take care of it within 5 minutes on the listing agent side, and then follow up even 30 minutes, 45 minutes later with that pre-approval letter. I think is a good approach to that question and that solution. Mm-hmm. What else we got?
That is it.
Awesome. Mm-hmm. Hey guys, appreciate you so much for taking the time to ask these questions. It means so much to me that you actually are out there engaging with us and participating in all the things that we're doing and asking the questions and giving me an opportunity to answer them. So you guys keep asking them, I'll keep answering them.